Aloha, navigators. Stocks fell this week. Oil climbed, gold moved higher, the dollar weakened, Bitcoin surged, and US national debt crossed $40 trillion. That sounds like a bunch of separate stories. But underneath them was a market most beginners probably don't watch, the bond market. Because this week, the 30-year Treasury yield reached its highest level since 2007. And that matters because Treasury yields help influence the cost of borrowing throughout the economy. So how does a government bond connect to your mortgage, stocks, oil, gold, Bitcoin, and America's debt? Pulse, what happened?
Braddah, the warning light flashed in the Treasury market. On Tuesday, the 30-year Treasury yield reached 5.337%, its highest level since 2007. A Treasury is basically an IOU from the U.S. government. Investors lend the government money, and the yield is the return they demand for doing it. So rising yields can send a simple message. If you want my money for decades, I want a bigger return. Then Treasury announced it would double certain long-term bond buybacks from $2 billion to at least $4 billion per operation to help improve market liquidity. But bonds weren't the only story. Brent crude climbed more than 6% to around $94 a barrel as uncertainty involving Iran and the Strait of Hormuz continued. And U.S. national debt crossed $40 trillion for the first time. We also got two reminders that individual stocks can tell their own stories. Walmart dropped more than 9% after weaker than expected comparable sales, while management pointed to high gasoline prices pressuring consumers. Meanwhile, Moderna surged after positive late-stage results for its personalized melanoma cancer vaccine developed with Merck. The same week, very different reactions, so we know the headlines. But what did the markets actually do? Data?
Pulse, the numbers show a market pulling in different directions. For the week, the S&P 500 fell about 1.4%. The Nasdaq dropped about 2.1%. The Dow fell about 0.9%. And the Russell 2000 lost roughly 1.6%. But Bitcoin went the other direction, jumping roughly 20%. And there was real demand underneath that move. U.S. spot Bitcoin ETFs took in approximately $1.9 billion in net inflows, while spot Ether ETFs took in roughly $697 million. An ETF is an investment fund you can buy through a regular brokerage account. And an inflow means more investor money entered those funds than left them. So those numbers give us evidence that investor demand for crypto exposure through traditional ETFs strengthened. Now back to bonds. Here's one relationship every beginner should know. Bond prices and yields move in opposite directions. If an older bond becomes less attractive compared with newer bonds offering better returns, investors may only buy that older bond at a lower price. Price down, yield up. So when the 30-year Treasury yield reached 5.337%, investors were demanding more compensation to lend money long-term. The numbers tell us what happened, but why were investors demanding more? Atlas?
Data. There wasn't one answer. Several pressures were hitting the same system. Start with oil. Uncertainty involving Iran and the Strait of Hormuz helped push Brent crude above $94 a barrel, up more than 6% for the week. And you don't need to buy crude oil for that to matter. Oil helps power gasoline, airlines, trucking, shipping, and manufacturing. When energy gets more expensive, businesses can face higher costs, and some of those costs can eventually reach consumers. That's why oil can become an inflation story. And inflation matters to bonds. If you're lending money for 30 years and you're worried those future dollars may buy less, you'll probably demand a better return. But investors were also watching government borrowing. The U.S. crossed $40 trillion in total national debt this week, and financing government debt requires the Treasury market. So investors were weighing inflation, oil, and enormous borrowing needs while deciding what return makes lending money long-term worth it. And higher Treasury yields don't stay inside the bond market. They can influence mortgage rates and business borrowing. They can also pressure stocks because bonds offering higher returns create more competition for investor money. That's the connection. Oil wasn't just an oil story. Debt wasn't just a Washington story. And bonds weren't just a Wall Street story. They were all touching the same question. What should money cost? But investors don't only decide what return they want. They also decide where they want their money. Echo, what did that reaction look like?
Atlas. Investors didn't all react the same way. But there was a pattern worth noticing. The US dollar weakened during the week, while gold moved higher and Bitcoin surged. Part of that reaction involved purchasing power, simply how much your money can actually buy. When investors worry about inflation, government borrowing, or currencies losing purchasing power, some may look elsewhere. Gold has a long history as a safe haven, an asset investors sometimes seek during uncertainty. Bitcoin is different. It's younger, much more volatile, and doesn't always behave like a safe haven. but some investors view its limited supply as a form of scarcity. That brings us to a phrase that resurfaced this week: the debasement trade. It describes concern that currencies could lose purchasing power over time. But here's the important part: gold rising, Bitcoin rising, and the dollar falling does not prove the dollar is being debased. It tells us how some investors may be reacting to concerns about inflation, debt, and future purchasing power. That's sentiment. Market behavior can show us what investors are worried about. It doesn't prove they're right. So instead of asking who's scared, ask, what are investors doing with their money and why? But there's one part of this story we can measure more directly. Not just how much debt America has. What does that debt cost? Ledger?
Echo, that's the right question. The United States crossed $40 trillion in total national debt for the first time this week. That's enormous, but it doesn't mean America suddenly went bankrupt. And the full $40 trillion isn't all debt held by outside investors. So instead of panicking over one giant number, ask, what does the debt cost to carry? When government debt comes due, some of it can be refinanced. Refinancing simply means replacing maturing debt with new debt. If old debt was financed when rates were lower, but new borrowing happens at higher rates, carrying that debt can become more expensive. Federal interest expense is already approaching roughly $1.2 trillion this fiscal year. That's why debt and Treasury yields belong in the same conversation. Higher yields can increase the cost of new borrowing and refinancing. And as interest expense grows, more government resources have to go towards servicing that debt. Does that mean a crisis happens tomorrow? No. Does it mean the debt doesn't matter? Also no. The better risk question is whether debt and interest costs keep growing faster than the government's ability to manage them. So don't just watch the $40 trillion headline. Watch borrowing, watch yields, watch interest expense. Because the deeper risk isn't simply how much America owes, it's what America has to pay to carry it. Braddah, that brings us right back to the price of money.
Ledger, that's the connection. Navigators, this week looked like a bunch of separate stories. Stocks fell, oil climbed, the dollar weakened, gold moved higher, Bitcoin surged, and America's debt crossed $40 trillion. But now you can see the connection. Investors were asking one big question: what should money cost? When the return investors' demand for lending money changes, those effects can travel through government borrowing, mortgages, businesses, stocks, and eventually your wallet. And investors don't only decide what return they want, they decide where they want their money. That's why learning markets isn't about memorizing what's green or red. It's about asking what changed, why are investors reacting, and how do the pieces connect? If these stories keep developing, watch long-term Treasury yields, watch oil. And with government debt, watch interest expense, not just the $40 trillion headline. Because this week's lesson is simple. Money has a price. And when that price changes, the effects can travel almost everywhere. This is education, not financial advice. You be akamai now. O Bombay, you learn later. Aloha.